Are the glory days over for China's growth? It's not just a recent slump in China's factory confidence or lackluster consumer demand that is the problem. It's how to keep the world's second largest economy growing at a rate which exceeds expectations and defies the longer-term drift to slower growth, a problem which many mature economies are having to contend with. China's post-COVID recovery could be running out of steam at a critical time when the global economy is facing greater challenges. It should be a time when Beijing's dual circulation strategy comes into its own and domestic drivers compensate for any shortfalls on the international side. The risk is that Beijing's growth target of around 5% may be a bridge too far this year, and that a gross domestic product range of 3 to 4% may be the prevailing trend in the next 5 years. Beijing needs to pull out all the policy stops to prevent this. China can do better. Considering the high expectations for recovery after the easing of zero COVID controls last December, the economic performance has so far been underwhelming. Year-on-year GDP growth jumped to 4.5% in the first 3 months of 2023 from 2.9% in the final quarter of 2022. But this should have been better considering the pent-up demand in the economy after last year's tough trading conditions. Last year, the economy only added 3%, missing Beijing's 2022 goal of around 5.5%. The uncertain global backdrop and indifferent domestic conditions mean there's a lot of catching up to do. The economy is still vulnerable to global headwinds, something which the dual circulation strategy was originally designed to avoid. In the past few months, exports have bounced back, with overseas sales surging 14.8% year-on-year in March from a 10.5% collapse in January, although the growth rate subsequently moderated to 8.5% in April. World business conditions are not looking great, with the Global Manufacturing Purchasing Managers Index published by S&P Global and JP Morgan stuck in the doldrums below the boom-bust line of 50 for the past 9 months. The worry is that conditions could get even worse in the next few months. Global economic confidence is under pressure on many fronts. Global borrowing costs are rising. World trade tensions are high and geopolitical risks are acute, while financial market exuberance seems excessive and at risk of a serious correction at some stage. The world might have been spared a major economic shock over the United States debt ceiling crisis, but financial market sentiment is still exposed to more rounds of monetary tightening by major central banks unless inflation pressures subside much more quickly. The risk is that if monetary policymakers push too hard, the global economy might slip into recession. If world trade conditions are slowing, it's going to weigh heavily on China's export sector in the coming months, which means Beijing will have to place even greater emphasis on domestic reflation to compensate. If consumer demand and investment spending fail to take up the slack, it means Beijing's policy bias must stay skewed toward more easing, implying even lower interest rates and more government deficit spending to ensure domestic growth makes up the difference. In doing so, the question is whether China risks becoming more like the market-driven economies of the United States, Japan, and Europe, blighted by chronically lower interest rates and with overblown budget deficits becoming the norm. Clearly, there should be some scope for China's key lending rates to go lower, considering consumer price inflation remains so low at 0.1%. This is critically close to negative inflation or deflation, another sign that the economy is operating well below capacity. While easier monetary policy could be an option, the harm which cheap credit has already caused to China's housing sector in recent years suggests there should be better ways to boost economic growth potential without risking additional distortions of domestic asset markets. To boost China's economic growth potential without exacerbating distortions, the government should prioritize investments in key infrastructure projects. Such initiatives can enhance the mainland's productive capacity, generate positive multiplier effects, and stimulate long-term growth prospects, increasing the government's budget deficit as a percentage of GDP, possibly surpassing the previous peak of 8.6% in 2020, could provide the necessary resources for these infrastructure investments. Although this approach would require additional spending, it can yield substantial returns by putting China back on track to achieve its growth target of 5% this year. Furthermore, it is crucial for the government to adopt sustainable and environmentally friendly practices in infrastructure development, aligning with China's commitment to carbon neutrality. By embracing clean and green technologies, China can drive economic growth while addressing environmental concerns and creating a more sustainable future. Amid the challenges, China also has ample opportunities to capitalize on innovation and digital transformation to drive economic growth. The country has made significant strides in areas such as artificial intelligence, 5G technology, e-commerce, and fintech. By fostering an ecosystem conducive to technological advancement, China can position itself as a global leader in innovation, attracting investment and generating high-value jobs. In conclusion, China's growth trajectory is encountering obstacles that demand strategic policy responses. Balancing domestic reflation with cautionary measures, such as ensuring sustainable interest rates and fiscal discipline, can help navigate the challenges and maintain steady economic growth. Thank you for watching this video to the end. Subscribe to the channel and write your opinion in the comments.